Our previous session covered debt financing. This session covers the other major type of financing, equity financing. We cover 7 topics. We return to patterns of corporate financing. Then we look at equity on the balance sheet. We focus on common stock. We describe preferred stock. Then we show the distribution of equity ownership. We describe the sequence of developing equity within the firm. And we conclude with other equity terminology we haven't covered yet. Let's look one more time at the right side of Merck's balance sheet. This time we concentrate on the bottom of the statement, the equity section, down here. It's typical to have several lines in the equity section. Here for Merck we have common stock at par, other paid-in capital, retained earnings, and then down here, treasury stock. We'll define and discuss each of these terms and concepts, mostly in this session, but some in the next session. The first equity line on the balance sheet is usually common stock at par. For Merck, par value is 1 cent. The BMA text notes that while firms typically have to establish a par value for their stock, par value has little economic meaning. My experience in Michigan, in which I was a founder of a failed startup company, is that we founders had to purchase our initial shares for the par value, plus the sweat equity we put into the company. So the meaning of par can vary depending on the state of incorporation. Additional paid-in capital is the difference between par value and the value of equity raised when stock is sold by the corporation to its owners. For example, if the corporation sells stock to its owners at 1 cent or at par, there is no additional paid-in capital. If the corporation sells its next batch of stock to venture capitalists at $1 per share, such stock sales now show on the balance sheet as 1 cent par and 99 cents additional paid-in capital. Retained earnings are the excess of profits over dividends paid out over the life of the firm. I'll define preferred stock a bit later in this session. Now let's move to the distinction between book value and market value. Merck's balance sheet presents the book value of its equity. Here are the numbers. According to the balance sheet, Merck has about $17 billion in equity, consisting mostly of retained earnings. But this is not the market value of Merck's equity. To find the value of Merck's equity in the market, you first determine the number of shares in the hands of its owners. That number is total shares issued and outstanding, minus treasury shares, or the shares repurchased by Merck from its owners. So Merck has 2.976 billion shares outstanding, but it's repurchased about 3/4 billion shares back from its owners and is holding those shares in the treasury. So there are 2.2 billion shares of stock outstanding. You multiply that number by the current market price per share of stock. In Merck's case, the share price at the end of 2004 was about $46. So the market value of equity was over $100 billion, or roughly 6 times the book value of equity. When the market value is a large multiple of book value, the market value of the firm has risen substantially from the time the equity came into the firm, and the equity would come into the firm either from a stock sale or from retained earnings. Note that growth stocks have a high market value to book value. Owners of common stock share in the ownership of the firm. They get to vote in the affairs of the firm, including electing the board of directors, and they get to receive dividends if the firm chooses to pay dividends. But recall that they have the last claim on the cash flows of the firm. That is, common shareholders get paid last after all the other claimants on the cash flows of the firm have been paid. Hence, the common shareholders bear the highest level of risk associated with cash flows of the firm. The value of common shareholders' ownership shows up as book value on the balance sheet, where book value is the capital a firm has raised from shareholders in the past over the history of the firm. But the true value of the common shareholders' interest in the firm is given by market value. Recall from earlier in the course that the determination of stock value depends on future dividends and share price appreciation that the shareholders expect to receive. Owners of preferred stock receive fixed dividends. They hold priority in dividend payment over common shareholders. That is, they have a prior claim on the cash flows of the firm. Preferred shareholders have no voting rights in the affairs of the firm. Preferred stock can be thought of as a quasi-debt in the sense that preferred shareholders receive a fixed dividend payment in the same way that bondholders receive a fixed interest payment. However, there's one important distinction between preferred stock and bonds. In the event that the corporation defaults on its bonds, or even if it misses an interest or principal payment on its bonds, it can be forced into financial distress or bankruptcy. But if the corporation misses a preferred stock dividend, there's no implication that the firm will be forced into bankruptcy. Now let me introduce a new term, which is net worth. Net worth is sometimes used interchangeably with equity. Net worth is typically measured as the book value of common shareholders' equity plus preferred stock on the balance sheet of the firm. Here's a representation of the distribution of equity ownership for U.S. corporate equities. About half the value of U.S. equities is in the hands of institutional investors, that is, pension funds, insurance companies, and mutual funds. But a substantially larger share of equity is held directly by households than was true of corporate debt. For most of the rest of this session, I want to describe the process of developing equity in the firm. This process follows a sequence of ownership that starts with the firm's founders, typically proceeding to to venture capitalists, and then to the public. Let's say a few people get together and hatch an idea for a new business. An example is an electronic drug prescribing system. And yes, I'll allow that this was my failed venture. These people, who are the firm's founders, put time, energy, sometimes muscle, and sometimes brains, plus a bit of cash into the new firm. They may incorporate. As time passes, they accumulate value in the form of assets, and the value of their assets is supported by their equity in the firm. So here might be the value of the assets that have been created over time, and here's the value of the equity of the founders of the firm at that time. Now in my case, the asset was a rudimentary software program for prescription writing. There comes a point when the founders need cash to take the firm to the next stage. We realized that we needed the assistance of a professional programmer. So the firm approaches venture capitalists. In places such as Ann Arbor, there are forums that bring together founders and venture capitalists. At these forums, founders pitch their ideas in a confidential setting to potential investors. So let's say the firm is successful in getting venture capitalists to put up $1 million in cash in exchange for $1 million worth of equity, or half of the equity value of the firm. With this cash, the firm can now proceed with the next phase of product development. As the product gets developed and the business concept becomes proven, the value of the firm's assets and equity rise in terms of business potential. The firm has a product developed, but it needs a production facility and a marketing capability. Hence, it needs more cash, so it approaches the venture capitalist market again. But this time the firm has more credibility. It has a developed product and a proven business concept. So the firm can now get more cash for a smaller share of the business than in the first stage. It raises an additional $4 million in cash from the venture capitalists in exchange for about 29% of the firm. The final stage in initial equity creation is taking the firm public, or selling stock to the public. An initial public offering, or IPO, is the first offering of stock to the general public. An IPO is often done through an underwriter, which is a firm that buys an issue of securities from the company and resells the securities to the public. In exchange for this service and for the risk involved, the underwriter typically establishes a spread, which is the difference between a public offer price and the price paid by the underwriter. In an IPO, the public offer price depends on the firm's future earning potential, the number of shares that are going to be issued, and the percentage of the firm going into the hands of the public. This information and other aspects of the firm are described in a prospectus, which is a formal summary that provides information on an issue of securities. If the IPO is successful, the market value of the firm's shares is established. the founders may get rich, and the firm is launched. This graph shows the trend in venture capital investment in U.S. corporations. You can see that the era of venture capitalism kind of began in the mid-90s and reached a peak in the year 2000. Now you'll recall, some of you will recall painfully, that in 2000 we had a significant stock market reduction. After that crash, the venture capitalist activity diminished substantially. It was cut by more than 60% in 2001. And in subsequent years, venture capital activity has continued to be at a relatively low level. Let's conclude this session with some other equity terminology that we haven't yet covered. A seasoned offering is the sale of securities by a firm that is already publicly traded. So the firm has already had an IPO and now wishes to raise additional cash with another sale of stock to the public. A general cash offer is a sale of securities that is open to all investors by an already publicly traded company. A general cash offer is distinguished from a rights issue, which is an issue of securities offered only to current shareholders or current stockholders. Finally, a private placement of equity is the sale of securities to a limited number of investors without a public offering.